So you've inherited an IRA. Now what? You're at a crossroads of tax planning, financial planning, and estate planning, and you're probably wondering which road to take. When you're at a transition like this, especially if it happened suddenly or unexpectedly, you're likely not focused on taxes, laws, all of those different types of things, which is where mistakes can happen. So, going through the motions and making a quick, uninformed choice or decision could cost you a portion of your inheritance in taxes or even IRS penalties. I'm Amber Knips, a wealth advisor at Sweet Financial Partners located in Fairmont and Jackson, Minnesota. And I specialize in working with high net worth individuals as they navigate life's biggest transitions, both expected and unexpected. We believe that everyone has the right to realize that their dreams are possible, and we use that when working with clients to help them plan for the future. Your first instinct might be to simply collect the funds from the IRA, take that lump sum distribution, put it in your account, and then go and meet with an advisor and say, okay, now what? But that's probably one of the worst things that you can do because at that point you're in trouble. You've lost any flexibility that there was. So before that happens, let's go through these different must know tips for handling an inherited IRA. First and foremost, get a grasp on what you're inheriting. And what I mean by that is first figuring out what type of an account you inherited, meaning is it a traditional IRA or a Roth IRA? This is important because it helps you understand the income tax obligations that you have. So it maintains the same tax status it did regardless of who's owner of the account. So if you inherit an IRA, it stays in that same IRA bucket until you're ready to take a distribution. So something that I want to mention is if you're inheriting in an IRA along with somebody else, maybe a sibling or something like that, you do not have to do the same thing as them. Once the IRA shifts into your name, then you have the flexibility in order to invest according to your goals and create a strategy that works for you. So recent legislation such as the Secure Act has outlined some really important rules in regarding inherited IRA accounts and how you'll be taxed on them, what the different rules are for taking those distributions. These can depend on a handful of different factors, such as your relationship to the person you inherited the account from, as well as if it's an IRA or a Roth IRA, and looking at ages. So it's really important to understand that these changes are fairly recent. So it's also ever changing. So doing a quick Google search to say, hey, I need an answer to a question quick would not be recommended because it's no guarantee that you're reading something that's been updated to the new rules or that they've interpreted correctly. Which leads me to the next step, understanding your distribution options. So you cannot leave money in the original IRA account opened by the deceased person. So you need to open an IRA account in your name and have funds shifted over. So just like the original owner, you will not be taxed until you take funds out of the account. So you do have a little bit of control when it comes to tax planning. So there's some different things to note in there and consider. If you are under age 59 and a half and you've saved in IRA accounts, if you were to take a distribution, there is a 10% penalty, but that does go away when inheriting accounts. So that's a unique situation as well, that you do have access to taking those out penalty free, not income tax free. Something else to understand is that the inheritance rules differ according to the type of beneficiary that you are, whether you're a spouse or a non-spouse. A spouse has the most options and the most leeway. As a spouse, you have the ability to treat it as if it's your own and combine it into some of those other retirement accounts, or you can treat yourself as a beneficiary on the plan. So there's kind of a whole handful of different things that determines what's the best way to treat that, because you might not have to withdraw funds depending on your age. So if you're not interested in taking out any funds and you want to have them continue to grow, that's something that's really important to consider. As well as if you're under age 59 and a half and maybe you need some money for a cash flow, it could make sense and be in your best interest not to treat the IRA as your own, because then you're not subject to that 10% penalty if you keep it into that inherited account. So a non-spouse beneficiary, however, has a little bit more limited options. And under the new Secure Act, there's actually a new rule that the IRA must be distributed completely within 10 years if that IRA owner passed away after January 1st, 2020. So important translation there is that you would have to pay tax on the entire account within that 10-year time frame. So especially, depending on account balances, some really important planning opportunities to go through. There are a few different exceptions, like we had discussed earlier with spouses, as well as for minor children, disabled individuals, and anyone less than 10 years younger than the one who had passed away. So these individuals are sometimes referred to as eligible designated beneficiaries. They have the ability to stretch that account out over, a different life expectancy than the 10-year time frame. One thing to note, if for a minor, once they do become age of majority, which varies a little bit for each state, then they have to distribute after that from the 10-year time frame. So there are a couple important things to note if you fall in that category. And I'm sure right now you're starting to realize, holy cow, there's a whole lot of things to consider and, understand. It's not really a one size fits all. So really important to consider all of the different options, your age, the age of the person that you inherited the account from. When you're considering how to take withdrawals, you'll really need to understand too, all of the different considerations and what's that going to mean for you from a tax standpoint. So a trusted advisor can help you work through all the considerations and really understand what makes the most sense for your situation, since we're looking at a lot of different things that need to get married together: tax planning, estate planning, and financial planning. So along those lines brings us to point number 3, which is being aware of year of death required distributions. So this is another hurdle for beneficiaries to try and figure out is, had the original owner taken out that required minimum distribution, or RMD, in that year? So if the original owner hadn't, it's up to your responsibility as a beneficiary to make sure that amount gets taken. So let's say one of your parents pass away in January, you receive that IRA. They probably haven't taken out that RMD yet. So in a case like this, it's up to you to take if they hadn't. And if you didn't know about that requirement, or maybe you forgot to do it, there is a pretty hefty penalty that's imposed on the amount that wasn't taken, in addition to some tax. So something really important to consider, and make sure that you're working with a really good advisor to help you through all of those different things. So, not surprisingly, that can be an issue if someone passes away late in the year and they hadn't taken that RMD yet. So let's say instead one of your parents passed away late December and they hadn't taken that required minimum distribution. You might not even know that they hadn't taken it before, and then it could be too late. So something really important to consider and kind of keep in mind is that does have to be done by the end of the calendar year. So, which is a really great lead into my next step, is it's time to do some tax planning. And when isn't a good time to do tax planning, but especially when you inherit an IRA account. As I mentioned before, there's a big crossroads that you're coming to. So it's important to do tax planning and understand the impact that it's going to have on your finances, since now it's going to be a little bit different than what you've been planning before. So any withdrawals from a pre-tax account, think traditional IRA, SEP IRA, simple IRA, are fully taxable. So let's say you take a $25,000 distribution, you now have to report that full amount on your tax return as income. Anyone who inherits a Roth IRA shouldn't have to pay taxes on the distribution if the original owner opened it at least 5 years before, or had converted it 5 years before. So it's really important to know when that account was opened to understand if any of that would potentially be taxable. I recently sat down with someone who had just inherited a pretty sizable IRA account, And the first thing they said was, ah, I hate paying taxes, which I don't think I've ever had anyone sit down and say, I love paying taxes. But what they had done is they'd said, well, I put the numbers together, divided the account balance by 10. I'm just going to take out that amount every year, which isn't necessarily a bad plan, but I had a feeling it wasn't the most tax efficient plan. So I reviewed their tax return. I went through, figured out where's their tax bracket now, where do I think they'll be over the next 10 years? And looking at that, they actually had a little bit of space within their current tax bracket. So, looking at that and knowing the potential changes to tax brackets in the next couple of years with the Tax Cuts and Jobs Act expiring and knowing that they are going to set to retire in the next couple of years, for them, there was a lot more benefits to speed up those distributions instead of taking an even amount every year. So for them, it made sense to take a little bit more now and then pause a little bit, and then take a little bit more again later. So it's not always black and white. So taking the time to do some careful planning can be really advantageous. And depending on the situation, there's some potential benefits to even speeding up a little bit more, possibly. So, one of those would be a lower tax bracket. So, just like in the story I just shared, by withdrawing more from the IRA earlier, then you have a little bit more ability to spread that tax liability out, potentially keeping you in a lower tax bracket versus having that big chunk that has to come out at the end. So, some important things to look at is where you are in that bracket. The other thing to consider is tax diversification. So, by taking withdrawals earlier, you can potentially diversify that tax out a little bit more, especially if you expect income to increase in the future. Or, maybe you'll have to start taking that required minimum distribution at some point, and maybe it's better to try and get a little bit more out of the way before you have to start taking that amount every year. So, looking at some of those different pieces as well as estate planning considerations, depending on your estate planning goals, where you are in regards to estate tax limits, taking withdrawals now might make sense to try and minimize your overall estate and be more tax efficient for your heirs. So before you're like, yep, sign me up, let's take it all out in the next couple of years, there's some important things to also think about is the negative impacts of that. Is any distributions could bump you into a higher tax bracket. They could affect your deductions or even your Medicare premiums. So I've also have a really good video that dives into that a little bit more of talking about some mistakes that we see in regards to Medicare and, specifically talking about premiums and some strategies in how to avoid that extra surcharge, which I will link below. So as you can see, there's a lot to think about. The rules are pretty complex, especially if you're inheriting an IRA with a significant balance, because that translates into potentially a significant tax bill. So if the right planning's not done, you can fall into that camp. So taking a little bit extra time to do some extra planning can be advantageous, because inheriting an IRA can be a significant gift from someone that was important to you. So enlisting the help of a professional can help that go a little bit smoother and really help you maximize the gift that was given and carry on that legacy.